The U.S. Federal Reserve is set to increase interest rates throughout 2018, and this will encourage equity markets, according to J.P. Morgan Asset Management's newest quarterly markets outlook.
The central bank announced in March that an increase in rates and hinted the route of rate hikes may be competitive. Markets are largely pricing in 2 more rate rises this year, though some analysts foresee 3 greater increases from the end of 2018.
Higher interest rates are traditionally seen as a negative for stock markets. This is because higher rates mean that companies will have higher borrowing costs and, thus, less room to pay dividends to investors. However, according to J.P. Morgan Asset Management, the path of rate increases will be very slow and gradual and is unlikely to significantly restrain corporate earnings or equity returns.
Interest rates aren't anticipated to pose a problem for the economy or equity markets this year, Mike Bell, global market strategist at J.P. Morgan Asset Management, said in the quarterly report out Tuesday. Instead, financial stocks should benefit. This is because higher interest rates allow banks to charge higher fees and, thus, boost their performance. The report said that equities have only come under pressure when the 2-year Treasury yield rose above 3.5%. It currently sits at 2.4%.
The outlook warned, however, that it is important to keep an eye on the yield curve, which tracks the movement of both the 10-year and the 2-year Treasury yield. Prior to some of the past recessions, the 2-year Treasury yield rose above the 10-year yield, although at the moment, the former is still below the 10-year note, but has recently moved closer to it.
But there are divergent opinions about the future of the equity market.
Yassine Kanoun, managing director at Shield Portfolio Management, told CNBC's Squawk Box Europe that there will be a 1 or 2% increase in stocks, but then they will come off.
After the first surprise effect of the earnings, which started last week, I think that in the next few days we are going to increase another 1 or 2% and then it will be over, and then the market might fall, and if it reaches again below 2600K is going to accelerate down, he said.
The S&P 500 is currently above 2700K. For the last week it has been supported by stronger than expected earnings, including by Netflix, Johnson & Johnson and Goldman Sachs.
Francesco Filia, chief executive at Fasanar Capital, said that the recent sell-off in bonds and equities could be an early warning signal of what is to come. In March, equities were under pressure after concerns of tougher regulation on tech companies as well as over fears of a potential global trade war. In February, markets saw a correction on rising worries over a sudden uptick in inflation.
Ci set, ma tu ci no d'amor.